So what is the difference in a commercial loan and a residential, like a Fannie Mae or a Freddie Mac or an FHA or USDA or VA loan? What's the difference?
When we're talking about an investment loan, we are going to qualify the purchase or the refinance of that property based on the property income, the borrower's experience in owning and managing investment real estate and things like that. We're not going to need any heavy-hitting underwriting information like tax returns, employment verification, all that kind of stuff. It's really based on the asset itself.
For these commercial loans, the money comes from either private lending institutions or banks or something like that. It's not coming and being insured by the federal government. Is that correct?
Correct. They do get securitized, especially these DSCR loans, but they're generally being originated by a direct lender.
Yep.
So they underwrite and fund that loan. But to keep themselves capitalized for next month's fundings, they go ahead and sell that note to a big institutional note buyer who then goes along and securitizes.
Maybe slices it up and sells it off to bunches and bunches of people. Okay, so what this is a big setup for what is a DSCR loan. Tell us what DSCR stands for first.
Yeah, happy to. DSCR stands for Debt Service Coverage Ratio.
Okay.
To break that down, the income of the rental property covers the cost of the mortgage expenses, the taxes and insurance, and provides a bit of profit to the borrower, a bit of protection there. The borrower needs to make some profit to make it make sense.
Let's say we've got a property and the cost on the property would be, $2,000 a month. And so what would the DSCR, what would the debt service coverage ratio need to be today for most people to get approved? I know it's either, like 1.1 or 1.2 or 1.3, which means if we took the 2,000 and let's say it was a 1.1, then that means I need to be able to rent it for 2,200. Is that correct?
You've got it basically correct there. That ratio, the programs generally allow flat coverage at one flat for a certain period of time. There's a couple of tricks that we can use, like an interest-only period for up to 10 years to improve that debt service, of course, if it's non-amortized. But you are correct. The ideal debt service ratio is 1.2.
And so for a DSCR loan, I would imagine they come with a little bit higher interest rate because the investor, in my opinion, is taking additional risk because, they're not necessarily underwriting me the way they would other places. So what would that premium be? So what I'm asking is how much more interest would you pay than you might pay to purchase a single family home?
It's not egregiously much more.
Okay.
You're on the right track there. The risk profile, the risk exposure for the lenders in this space is a bit elevated, so the rate is a bit higher.
Yep.
If a conventional conforming loan is getting 6.25, I have seen in recent days the floor rate on some of these DSCR products advertised at 6.5. That's the floor rate. Now, once we go for maximum LTV, and maybe we've got a credit score that's not above 720 where ideal is, something like that, we're going to get an elevated. I'm seeing most of them come in between, as you mentioned, 7.25 to for less favorable situations up to 9.25, something like that.